Okay, so these schedules, and we're mainly going to talk about the M1 here. Schedule L is just the balance sheet, and it's the balance sheet per books. And if a corporation's total receipts and assets are less than $250,000, you don't have to prepare it. Our practice was always to prepare it anyway, because it can be very helpful just in tracking from year to year. But you don't have to have an M1, and you don't have to have a Schedule L or balance sheet if the receipts, or total receipts and total assets are both less than $250,000. Again, that Schedule L is simply the balance sheet that was from the financial records. If your financial records are kept on a tax basis, then it's going to be a tax basis balance sheet. It could be a financial accounting basis as well, or some other basis. But whatever you're using to prepare the financial accounting records, that's the balance sheet that then will be transferred over to the tax return. So that's fairly simple, right? As long as you've got a balance sheet that was done for financial accounting purposes. The M1, however, has a lot. You have to really think through a lot of this stuff. Like, you have to stop and slow down and think through how this M1 works, because you're adding and subtracting items from our income per books, and you have to think, well, did this increase net income or did this decrease net income, and is it a difference between how it's treated for tax purposes? It can get kind of hairy. So reconciles the net income per books with the net income per the tax return. So you're taking whatever's on your financial accounting income statement, the bottom line number, the net income, that goes on line 1 of the M1, and you are making adjustments to that number to get to the amount on line 10 of the, well, actually line 10 is on the tax return. So the amount that's actually on the first page of the tax return, the corporate tax return. Like I said, they do these for partnerships and S corporations as well. It goes, and again, we're going to start with the financial accounting income and work our way to tax income. So this is just sort of this is what the M1 looks like down here, but I'm going to kind of go through. They've got a narrative up there that describes each of these lines, so I may scroll back and forth a little bit between these. So line 1, as they mentioned here, line 1 is whatever our net income was per books, so just transferring that number over. Line 2, federal income tax is an expense for book purposes. It's not deductible for tax purposes. I mentioned that earlier. You don't get a deduction for the federal taxes that you pay, but it is listed as an expense, and so it would have been subtracted from our book income when we calculated net income, right? So the amount of federal income tax expense has to be added back to book income. Okay, so it's a plus. So everything on the M1 on the left-hand side is an add back to book income. And everything on the right-hand side is a subtraction from. Okay, so again, we're going to start here. Line 1 is our book income. And here, I can't remember what the number of the line is. Is it line 10? Line 10 is our tax. Or loss. And this could be a loss. So we kind of work our way down, and then back up to here, and then we work our way down here. So this is the path that we take on the M1. So federal income tax is an expense. Anything that is an expense for book income, but not an expense for tax income. So expenses, I should say not deductible for tax. Is going to go over here on this side. So expense for book, but not deductible for tax purposes. Federal income taxes is one of those things. We expensed it on the books. We're not expensing it or deducting it on the tax return. Line 3, where are we here? Excess of capital losses over capital gains. So, for book purposes, any excess capital losses would qualify as an expense. So if we had a loss for book purposes, we have a piece of equipment or some sort of asset, a piece of equipment that we has a basis of $10,000 and we sold it for $5,000. Well, we would have a $5,000 loss, and that would be an expense that would reduce our net income for books. Well, it doesn't though, it's not deductible. Those losses aren't deductible for tax purposes. So for tax purposes, corporate capital losses are deductible only to the extent of capital gains. So any excess of capital losses over capital gains has to be added back to book income. All right, line 4, certain income may be taxable but not included in book income. So this is, we've got expenses for book, but not deductible for tax. And then we have income for tax, not income for book. So something that is income on the tax return, but it's not income on the books. We're going to have to add that. Let's see. Examples would include last month's rent collected, at lease, signing by a landlord, installment sale income reported in full on the books in a prior year. So these items have to be added to book income to arrive at taxable income. So anything that's income for tax purposes that we included on the tax return, but we did not include it as income on the books. Okay, I'm trying to think if there's another less obscure example, something like that. I can't think one off the top of my head. Maybe something will come to me. Okay, line 5. So that was line 4 there. Income subject to tax but not recorded on the books. Line 5, expenses that are recorded on the books but are not deductible on the tax return. So this is just the general category of this. The difference between accelerated depreciation taken on the books and straight line depreciation for taxes in the early years of an asset's life. So if we've got, or any type of depreciation where we had greater amount of depreciation on our books, but less on the tax return, because there's going to be a difference because we're using different depreciation methods. Difference between the book and tax deductions if charitable contributions are limited on the tax return. So again, if we have charitable contributions, but the amount of charitable contributions exceeded 10% of our taxable income, we're not going to be able to take all of that expense on our taxes, so there's going to be a difference. But we would have them as an expense on our books. Okay. Let's see, what else? 50% meal expenses as well. So we would have taken 100% of our meal expenses on our financial statements, but we can only take 50% of them on our tax return. Okay, so again, we are adding these back, plus over here are going to be the minuses. 'Cause 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 Yeah, for 2021, 2022, they took away that 50% limitation, so you didn't have this on the M1, but now it's back. What do we, entertainment expenses, memberships, that sort of thing are no longer deductible on the tax return, but for book purposes, they would be listed as an expense. All right, now we go over to the other side. And if you see, down here we kind of get a subtotal. So we're gonna add all of this. We have our subtotal down here. Then on the right-hand side, we start subtracting. Income that's reported on the books but not reported on the tax return. So again, we've got, I'm going to put that down here. So income for books, not for tax. Life insurance might be one of those examples. Life insurance is not any life, and this is where the company is the beneficiary of the life insurance policy. So if the company received life insurance benefits, maybe one of their executives passed away or something like that, and they received life insurance benefits are not taxable. They're not taxable to individuals, they're not taxable to anybody. So those proceeds are not taxable, but it would be included on the books as income that came in, right? They have other interest from tax exempt bonds. So interest, like municipal bond interest, is not taxable. And so it would not be included on the tax return, but it would be included on the books. So we're going to subtract that amount. And then we have deductions taken on the tax return, but not taken in the financial record. So we've got expenses, or actually deductible for tax deductions, not expensed on books. Okay. So we kind of have these four main categories of adjustments to arrive at our income. So depreciation again. Maybe we have more depreciation for tax than we do for financial accounting purposes, right? So that might be, so that's why you'll see over here, we've got depreciation on both sides of this. So depreciation and depreciation. It could be an add back, it could be a subtraction, right? Either way. Charitable contributions. What is it? So if you had say you had a carry forward, a charitable contribution carry forward because you couldn't take it in a prior year. Well, now on your tax return you get to take it, but on the financial statements you already expensed it in whatever year it was that you made that contribution, right? Same thing for capital loss carry forwards, right? So if you had, it would be, you might have a capital loss carry forward that's offsetting capital income this year on your tax return, but on your financial statements, you don't have that deduction. So that would be another category, another example, okay? Most times these are items that were deducted from a prior year. So a lot of times some of these are timing differences that are going to be temporary. So eventually it's all gonna kind of, as time goes on, it's gonna even out. Some of them are permanent differences though. Like I said, the life insurance example, or the 50% meals, that's never gonna even out because they're just treated differently. Life insurance is not income for tax, but it is income for books. It's not something that gets evened out over time, okay? So you've got some permanent differences and some temporary differences. Most of them are temporary, but some of them are permanent. So here's an example. Martin Company had book income of $50,000, so that'd be their line 1 here, 50,000. It also had the following differences between book income and tax income. So they had charitable contributions carry forward used in the current year, so that would be a deduction for tax, but not expensed on the books. And they had excess depreciation on the tax return. So another deduction for tax, not expensed on the books, right? So in addition, they incurred $10,000 of non-restaurant meal expense, only 50% of which was deductible for taxes. So $10,000, they've got a $5,000 adjustment over here because they got expenses for book, but not deductible for tax. So we would add back the $5,000 here, and then we would subtract the $2,000 and the $6,000. So we're gonna get to, so book income was $50,000, subtract the $2,000 and the $6,000, and then add back $5,000. So their tax income is $47,000. Now we're not calculating their tax income here. We've already calculated this. We should already know what this number is. It's on the first page of the tax return. When we're making these adjustments, we have to arrive at that correct number. So if this $47,000 is not what's on the first page of the tax return for net income, we've done something wrong. We've got an error probably on our M-1 somewhere. We've missed something, or we've included something that shouldn't have been included. Most times in practice, it's that you've missed something. Okay. So here's what it would look like. So the additional depreciation that was on the tax return, the carry forward of the charitable contributions that was on the tax return, and then half of the, and they've got it under travel and entertainment here. It's just meals. I don't know why it doesn't say meals. It said meals in the past, I believe, 50%, but for some reason on this one it doesn't actually specifically say it. But that's where you would put it. If you don't have, usually you've got like a bunch of items that you're reconciling, and obviously this isn't enough space. So on the tax return, it's gonna create an additional schedule where all of those things are listed out, and then this is just kind of a summary. I know for a fact you have a homework problem that is going to cause you much consternation with this. So I'm gonna take a picture of this before I start with the next section. Okay. So the M3, if a corporation has total assets of 10 million or more, they have to complete this Schedule M3, which is an even more detailed M1. But they only have to do that if their total assets are 10 million or more. It's just a little bit more involved. All right, questions?